Something unusual is happening in the silver market right now. And if you're not paying attention, you're missing one of the most significant financial stories of the decade. I'm not talking about the daily price movements that flash across your screen. I'm talking about a structural breakdown that's been building for years, and it's finally reaching a breaking point. Welcome to Money Aftermath. Before we dive into what's really happening behind the scenes in the silver market, make sure you hit that subscribe button and turn on notifications. Because when this situation unfolds further, you'll want to know about it before everyone else does. And drop a comment below telling me if you own any silver, and if so, what form. I read every single comment. Right now, as I'm recording this, silver is trading near all-time highs. The metal reached its all-time peak of around $79 per ounce in late December 2025, shattering previous records. But here's what most people don't understand. The price isn't the story. The price is just the symptom. The real story is what's happening in the vaults, in the exchanges, and in the delivery systems that most investors never even think about. Let me paint you a picture of how severe the situation has become. During the first 4 trading days of December 2025, over 60% of COMEX's registered silver inventory was claimed for physical delivery. 60% in 4 days. To put that in perspective, that's an unprecedented drain of metal that has never happened this quickly in the modern era. This isn't normal market behavior. This is panic buying at the institutional level. And it's not just happening in New York. London's vaults, which held 31,000 metric tons of silver in June 2022, had dropped to around 22,000 metric tons by March 2025. That's a third of London's silver inventory gone in less than 3 years. One trader told reporters that at one point, borrowing silver overnight was costing 200% on an annualized basis. Think about that. 200% just to borrow metal for one night. That's not a functioning market. That's a market in distress. Now, before I go further, I want you to understand something critical. I'm not here to tell you to buy silver. I'm not here to tell you to sell silver. I'm here to break down what's actually happening so you can make informed decisions. Because the financial media isn't giving you the full picture. They're showing you the price chart and calling it volatility. But what's really happening is far more fundamental than volatility. Let's talk about why this is happening. And I want you to stay with me here because this gets complex, but I'll break it down in a way that makes sense. The silver market operates on 2 levels. There's the paper market, which is where futures contracts, swaps, and exchange-traded funds live. And there's the physical market, which is actual bars and coins sitting in vaults. For decades, these 2 markets coexisted peacefully. The paper market provided liquidity and price discovery. The physical market provided the underlying asset. But here's the thing. The paper market has always been much, much larger than the physical market. Think of it like a bank. When you deposit money at a bank, the bank doesn't keep all that cash sitting in a vault. They lend most of it out. They operate on what's called fractional reserve banking. The system works as long as most people don't try to withdraw their money at the same time. The silver market works similarly. Most futures contracts are settled in cash, not physical metal. The system functions smoothly as long as most people accept cash settlement. But what happens when people stop accepting cash and start demanding metal? That's exactly what we're seeing now. And it's creating a problem that the exchanges can't easily solve. Let me explain why. For the past 5 consecutive years, global silver demand has exceeded total supply, creating a structural deficit. In 2024 alone, the deficit was nearly 150 million ounces. That's not a small gap. That's 10 months worth of global mine supply. Where does that missing metal come from? It comes from inventories, from stockpiles, from the buffer that keeps the system running. But here's where it gets really interesting. Industrial demand for silver hit a record 680.5 million ounces in 2024, and that marked the 4th consecutive year of record industrial demand. This isn't investment speculation driving demand. This is actual physical consumption that can't be satisfied with paper contracts. Factories need silver to make solar panels. They need it for electric vehicle components. They need it for artificial intelligence infrastructure and data centers. And they can't manufacture products with futures contracts. Let me give you some specific numbers so you understand the scale of what's happening. Silver demand from solar photovoltaic applications alone accounted for over 30% of industrial demand in 2024, and the sector is expected to continue growing rapidly. Electric vehicles use 67 to 79% more silver than traditional cars, with each EV containing between 25 and 50 grams of silver. Global IT power capacity for data centers increased by approximately 53 times from 2000 to 2025, translating into massive increases in computing hardware and silver demand. This is critical because industrial demand behaves differently than investment speculation. When speculators get scared or when exchanges change rules, speculators can be forced to liquidate. They don't need the commodity to survive. But industrial users can't liquidate their need for conductivity. A factory can't tell its production line to stop needing silver because the price went up. They will redesign slowly. They will look for substitutions eventually. But in the short term, they must have the metal or production stops. That makes this demand sticky. That makes it structural. And that's why this situation is so different from previous price spikes. Now let's talk about the supply side, because this is where things get even more complicated. You might think that when silver prices double or triple, mining companies would just produce more silver, but it doesn't work that way. Here's why. Most silver doesn't come from dedicated silver mines. Silver mining is largely a byproduct of other metal production, primarily copper, zinc, and lead. That means even if silver prices skyrocket, miners don't ramp up production based on silver economics. They ramp up when copper or zinc prices justify it. Silver is just a bonus. And even if companies wanted to build new dedicated silver mines, the timeline is brutal. Permits take years. Construction takes years. Refining capacity has constraints. Labor has constraints. Energy has constraints. By the time new supply comes online, the crisis that justified the investment might have already passed, or it might have gotten worse. Either way, supply cannot respond quickly to demand shocks. That's why inventories matter so much. They're the only buffer the market has. Now here's where we get into the really uncomfortable territory. What happens when that buffer runs out? What happens when the registered inventory at the exchanges drops so low that they can't satisfy delivery requests? There are really only two possible outcomes. Outcome one is that they deliver the metal at any price, and I mean any price. Price discovery gets forced upward until demand is rationed and new supply is attracted. Some analysts are talking about silver potentially reaching $100 per ounce or higher if this scenario plays out. Outcome two is that the exchanges redefine the rules. They force cash settlement, they raise margin requirements, they implement position limits, they pause trading, they do whatever is necessary to protect the system. And when I say protect the system, I mean protect the institutions that are on the wrong side of this trade. Because let's be clear about who gets hurt in outcome two. It's not the people demanding physical metal for their factories. It's not the people who own allocated bars in their own vaults. It's the people holding paper contracts who suddenly discover that their contract is a claim on cash, not metal. This has happened before in commodity markets. When stress becomes existential, rules change, and they change in favor of the system, not in favor of the individual contract holder. I'm not saying this to scare you, I'm saying it because this is the reality of how markets function under stress. The question you need to ask yourself is simple. If you're holding silver exposure, do you own the metal or do you own a promise? Let me give you something specific to watch for, because I want you to be able to track this situation yourself. First, watch registered inventory at COMEX. If it keeps trending down while open interest stays high, the paper to physical ratio is becoming more dangerous. Second, watch for backwardation in the futures market. That's when near-term contracts trade at a premium to longer-dated contracts. It's rare in metals, and when it happens, it signals immediate physical scarcity. The silver market has been experiencing backwardation recently, indicating strong physical demand and outflows from COMEX vaults. Third, watch regional premiums. If Asian buyers are consistently paying more for immediate delivery than Western spot prices, that tells you metal is flowing east and supplies are tight. Fourth, watch for sudden margin requirement increases at the exchanges. Those aren't random. They're designed to flush out long positions and reduce delivery pressure. And fifth, watch for changes in settlement language or delivery procedures. If cash settlement becomes more common, or if delivery terms get clarified with new restrictions, that's the exchange preparing for stress. Now, I want to address something that I know some of you are thinking. You're thinking, this sounds like a conspiracy theory. This sounds like one of those gold bug fantasies about the dollar collapsing and precious metals going to the moon. Let me be very clear. This is not about ideology. This is not about predictions of monetary collapse. This is about arithmetic. The numbers don't lie. Supply has been less than demand for 5 years straight. Inventories have been falling. Industrial consumption is growing. These are facts, not theories. What I'm describing is a supply-demand imbalance that creates pressure in any market, whether it's silver or semiconductors or lumber or anything else. The unusual part is that this imbalance is happening in a market with a large paper derivative structure sitting on top of it that amplifies the stress when it breaks. Here's something else you need to understand. The scale of leverage in these markets is enormous. When you short silver futures, you're not putting up the full value of the contract. You're putting up a fraction as margin. That leverage works great when the trade goes your way. But when it goes against you, losses multiply fast. If a concentrated short position represents hundreds of millions of ounces, every dollar move in price isn't annoying. It's potentially catastrophic, representing tens of millions in losses per dollar move. That's why this isn't just about silver. It's about what happens when large institutions take heavy losses on what they thought was a manageable position. They don't just lose money in isolation. They sell other assets to raise cash. They pull liquidity from other markets. They cut credit lines. That behavior ripples. That's how a commodity squeeze can become a broader liquidity event. And that's why even people who don't care about silver should be paying attention to this. Now, let me tell you about something that happened recently that should concern everyone watching this. In October 2025, lease rates for silver spiked to nearly 40%, compared to normal rates of around 0.3 to 0.5%. Lease rates are what it costs to borrow physical silver. Think of it like an interest rate, but for metal. When lease rates explode to 80 times their normal level, that's not a small imbalance. That's institutions desperately trying to source metal they promised to deliver, but don't actually have. Some of you might be wondering about China's role in all this, and it's significant. Starting January 1st, 2026, China implemented new export restrictions on refined silver, requiring special government licenses and an annual production capacity of at least 80 tons to export. These requirements effectively block hundreds of smaller and mid-sized exporters who have long served global markets. China is essentially locking silver inside its borders to support its domestic industrial needs. And when the world's largest producer restricts exports, global markets feel the pain immediately. This creates what some analysts are calling a two-price system. Physical silver in Shanghai is now trading above $80 per ounce, while COMEX futures remain much lower in the $30 to $35 range. Wait, let me correct that because prices have moved significantly. Current COMEX prices are actually much higher now, near $70 to $80, but the point remains that regional price differences signal severe market stress and the breakdown of normal arbitrage mechanisms. Now, let's talk about what this means for everyday investors. If you're thinking about exposure to silver, you have choices. You can buy physical coins and bars. You can buy exchange-traded funds. You can buy mining stocks. You can buy futures contracts. Each of these has different risk profiles, and they behave very differently under stress. Physical ownership means you actually possess the metal, but you have storage and insurance costs. ETFs are convenient, but during extreme market stress, some ETFs have struggled to acquire physical metal to match redemptions. Mining stocks give you leverage to the silver price, but they also carry company-specific risk and don't move one-to-one with silver. And futures contracts give you maximum leverage, but they also carry maximum risk and are subject to rule changes. I'm not going to tell you which is right for your situation. That depends on your goals, your risk tolerance, and your time horizon. But what I will say is this: if you believe the thesis that physical scarcity is driving this market, then physical ownership or allocated storage makes more sense than paper exposure. Because in a genuine supply squeeze, paper promises become questionable. Let me share something that might help you think through this. Ask yourself a simple question. If factories need silver to keep production running, and if governments see silver as strategic infrastructure for solar and EVs and data centers, who wins the bid when supplies are limited? Is it the retail investor holding an ETF? Is it the hedge fund holding futures contracts? Or is it the auto manufacturer who needs silver to build vehicles, backed by government policy that prioritizes industrial production? I think you know the answer. This brings me to a critical point that most analysis misses. When a commodity becomes strategic, the rules of the game change. It's no longer just about supply and demand curves intersecting at a market price. It's about national priorities. It's about securing supply chains. It's about ensuring domestic industries have access to critical materials. And when that happens, free markets take a back seat to policy. We've seen this play out with rare earths. We're seeing it now with semiconductors. And we're starting to see it with silver. Now, I want to address the elephant in the room. Volatility. Silver is known for being one of the most volatile commodities. It can swing 5 or 10% in a single day. That volatility is intentional. Let me explain what I mean. When institutions are trapped on the wrong side of a position, volatility becomes a weapon. Violent up days followed by violent down days create motion sickness. The goal is to make holding this position psychologically painful so that retail investors capitulate and sell. Professional traders understand this. That's why they focus on fundamentals, not on daily price action. So here's what you should ask yourself during every red candle. Did that down day put metal back in the vault? No. Did a scary headline increase mine supply? No. Did a margin hike create new silver atoms? No. The fundamentals don't change because your screen flashes red. The screen is noise, the vault is truth. If you want to track reality, don't stare at the tick chart like it's your religion. Track inventories, track premiums, track delivery behavior, track whether real metal is available without delay. Those signals matter infinitely more than the candle of the hour. Let me give you a specific example of how this plays out. Say you bought silver at $50 and it drops to $45 the next week. Your brain screams at you to sell because you're losing money. But if industrial demand is still growing, if inventories are still falling, if lease rates are still elevated, has anything fundamental actually changed? Or did the price move because a large institution needed to create volatility to shake out weak hands? This is the psychological battle that separates successful investors from unsuccessful ones. The ability to ignore price noise and focus on underlying reality. Here's something I find fascinating about this situation. The mainstream financial media is largely ignoring it. They'll report on the price when it makes a big move, but they're not explaining the mechanics of what's happening. They're not talking about registered inventory drains. They're not discussing backwardation. They're not covering lease rate spikes. Why? Because this story is complex. It doesn't fit into a 30-second soundbite, and it challenges the narrative that markets always function smoothly. But complexity is where the opportunity lies. Because when most people don't understand what's happening, those who do understand have an advantage. Let me share a historical parallel that might help you understand where this could be heading. In 1980, silver hit $50 per ounce during what's now known as the Hunt Brothers Silver Corner. Two billionaire brothers tried to corner the physical silver market by buying massive amounts of futures contracts and demanding delivery. The exchange changed the rules mid-game, implemented position limits, and forced liquidation. The price collapsed. The Hunt brothers went bankrupt. Now, I'm not saying we're in an identical situation, but I am saying that exchanges have a history of changing rules when the system is threatened. The difference this time is that it's not just speculators demanding delivery, it's industrial users who need the metal for production. That makes rule changes harder to implement without causing real economic damage. So what's the end game here? Honestly, I don't know. Nobody does. But I can give you the possible scenarios. Scenario one is that industrial demand slows, the global economy weakens, solar installation rates decline, EV production slows, data center build-out pauses, demand falls enough that supply catches up and inventories rebuild. In this scenario, silver prices might stabilize or even decline from current levels. Scenario two is that supply increases. New mines come online faster than expected. Recycling rates improve dramatically. Substitution technologies emerge that reduce industrial silver consumption. Base metal mining ramps up, bringing more byproduct silver to market. In this scenario, the supply-demand balance shifts and pressure eases. Scenario three is that the physical squeeze continues. Inventories keep draining. More countries implement export controls. Industrial users get desperate. Premiums explode. The paper market loses credibility. Silver reprices significantly higher as the market shifts to a physical-only price discovery mechanism. In this scenario, we could see silver at $100 or even higher as the market forces a new equilibrium. And then there's scenario four, which is the wild card. Central banks and governments intervene. They release strategic stockpiles. They mandate increased recycling. They provide subsidies for substitution research. They coordinate internationally to stabilize markets. In this scenario, the outcome depends entirely on policy decisions that are impossible to predict. My guess, and it's only a guess, is that we'll see elements of all four scenarios playing out simultaneously. Some demand will weaken, some supply will increase, some prices will rise dramatically, and some government intervention will occur. The question is, which force dominates? And that depends on factors that are constantly changing. Geopolitical tensions, economic growth rates, technology adoption speeds, policy decisions. It's a complex, dynamic system. But here's what I'm confident about. This situation is not going away quickly. Supply-demand imbalances that took 5 years to build don't resolve in 5 weeks. Inventories that took 3 years to draw down don't rebuild in 3 months. Industrial trends that are driven by multi-trillion-dollar infrastructure investments don't reverse on a dime. This is going to be a story for months, probably years. And it's going to have significant implications for anyone who owns silver, anyone who uses silver, and anyone who invests in markets that are connected to silver. Before I wrap up, I want to leave you with a few action items. First, if you own silver through ETFs or futures, understand the specific terms of what you own. Can it be cash settled? Is it allocated or unallocated? What happens during market stress? Read the prospectus, understand the fine print. Second, if you're considering buying physical silver, understand the premiums you're paying over spot price. Right now, premiums are elevated because physical demand is strong. That's normal during supply squeezes, but it means your break-even point is higher. Third, diversify your approach. Don't put all your silver exposure in one form. Mix physical with paper. Mix coins with bars. Mix direct ownership with mining stocks. Diversification reduces the risk that any single failure point destroys your position. Fourth, set up alerts for the key metrics I mentioned. Registered inventory, lease rates, backwardation, regional premiums. You don't need to check them every day, but you should be monitoring them regularly so you spot changes early. And fifth, have a plan. Know what will cause you to add to your position. Know what will cause you to reduce your position. Know what will cause you to exit entirely. Don't make emotional decisions in the moment. Decide now, while you're thinking clearly, what your rules are. Then follow those rules when the market gets crazy. Here's my final thought for you. Whether silver goes to $50 or $150 or back to $30, the real value in understanding this situation is not about making a profit on a trade. It's It's about understanding how markets really work. It's about seeing the gap between what's presented to the public and what's actually happening behind the scenes. It's about recognizing when a system is under stress before that stress becomes a crisis. These skills transfer to every market you'll ever invest in. Real estate, stocks, bonds, crypto, they all have the same dynamics. Supply and demand, leverage and deleveraging, paper claims and physical assets. Once you understand these concepts deeply in one market, you can apply them everywhere. So if you found this video valuable, hit that like button. It tells the algorithm to share this with more people who need to understand what's happening. Subscribe to Money Aftermath if you haven't already, because I'm going to be covering this story as it develops, and you'll want to stay updated. Drop a comment below with your thoughts. Are you buying silver? Are you selling? Are you watching from the sidelines? I want to hear from you. And share this video with someone who needs to see it, because this information is too important to keep to yourself. The silver market is sending us a signal. It's telling us that the old system is straining. It's showing us what happens when decades of promises collide with the reality of physical scarcity. Pay attention. Because what we're learning from silver today might apply to other markets tomorrow. And the people who see it early are the ones who will be prepared when it matters most. Thanks for watching Money Aftermath. Stay informed, stay critical, and I'll see you in the next video.